Top strategies for trading cryptocurrencies successfully. Cryptocurrency trading offers the potential for significant profits, but it also carries a high level of risk. With the volatile nature of digital assets, it can be difficult to know how to approach this market effectively. Successful crypto trading requires more than just luck. It demands the right strategies, discipline, and knowledge. In this video, we will explore the top strategies for trading cryptocurrencies successfully, providing valuable insights that can help you navigate the market with more confidence and achieve better outcomes in your trades. Understanding cryptocurrency markets. Before diving into the strategies, it's important to understand the cryptocurrency market itself. Cryptocurrencies, such as Bitcoin, Ethereum, and numerous altcoins, are traded on cryptocurrency exchanges, and the market is notoriously volatile. Unlike traditional stock markets, crypto markets operate 24/7, which means there are always trading opportunities but also continuous price fluctuations. Traders need to be prepared for rapid price movements and have strategies in place to manage these shifts. The primary factors influencing the prices of cryptocurrencies include market sentiment, regulatory news, technological developments, and macroeconomic events. Unlike stocks, cryptocurrencies are less influenced by company earnings or financial reports and are more susceptible to speculative trading and hype. Understanding these factors and being able to react to them appropriately is key to succeeding in crypto trading. 1. Hodling. Long-term investment strategy. One of the most popular strategies among cryptocurrency investors is hodling, a term derived from a misspelled word, hold. This strategy involves buying a cryptocurrency and holding onto it for the long term, often for years, regardless of short-term market fluctuations. The idea behind hodling is based on the belief that the long-term value of the cryptocurrency will increase significantly over time. Hodling works best with established cryptocurrencies, such as Bitcoin and Ethereum, which have a solid track record and large communities backing them. The strategy assumes that even though the market will experience periods of volatility, the overall trajectory of these digital assets will be upward. By holding onto your assets, you avoid making knee-jerk reactions to short-term price swings, allowing you to ride out market downturns. 2. Day trading. Taking advantage of short-term movements. Day trading is a strategy that involves buying and selling cryptocurrencies within a single day, aiming to profit from short-term price fluctuations. Day traders rely on market analysis, charts, and patterns to predict short-term movements and execute multiple trades throughout the day. This type of trading requires a keen understanding of technical analysis, including candlestick patterns, support and resistance levels, and indicators like moving averages, MA, relative strength index, RSI, and Bollinger Bands. Day trading in the cryptocurrency market is highly demanding, as traders must stay glued to their screens, monitoring price movements and making split-second decisions. However, it also provides the potential for significant profits in a short period if done correctly. This strategy is best suited for experienced traders who are comfortable with the fast-paced nature of the market and can make informed decisions quickly. Beginners should approach day trading with caution, as it requires skill, experience, and the ability to handle stress. 3. Swing trading. Profiting from medium-term trends. Swing trading is a strategy that attempts to profit from medium-term price movements over a period of days or weeks. Unlike day trading, swing traders do not need to monitor the market constantly. Instead, they focus on identifying price swings or trends, entering trades when a significant price movement is expected and exiting once the trend starts to reverse. Swing traders typically use a combination of technical analysis and market sentiment to identify trends. Indicators like moving averages, MACD, moving average convergence divergence, and Fibonacci retracement levels can help identify the right time to enter and exit positions. This strategy is ideal for those who can't dedicate full-time hours to monitoring the markets but still want to capitalize on medium-term trends. 4. Scalping. Making small profits from frequent trades. Scalping is a short-term trading strategy that involves making a large number of small trades to profit from tiny price movements. The idea behind scalping is that while individual price changes might be small, frequent trades can accumulate to significant profits. Scalpers take advantage of liquidity and small inefficiencies in the market to make profits quickly. They often rely on trading bots or high-frequency trading techniques to execute many orders in a short amount of time. Scalping requires a lot of focus, and traders need to be able to react quickly to price changes. It also requires low trading fees because the profitability of each trade is minimal. This strategy can be very demanding and is generally not recommended for beginners, as it requires a strong understanding of market mechanics, trading platforms, and speed. 5. Dollar cost averaging, DCA. A risk mitigation strategy. Dollar cost averaging, DCA, is a long-term strategy designed to reduce the impact of volatility by spreading out the investment over time. With DCA, traders or investors buy a fixed amount of cryptocurrency at regular intervals, regardless of the asset's price. For example, instead of investing $1,000 in Bitcoin at once, you might invest $100 every month over 10 months. DCA helps mitigate the risk of entering the market at the wrong time, particularly when the market is highly volatile. By purchasing at regular intervals, you avoid trying to time the market, which can be challenging even for experienced traders. While DCA won't make you a quick profit, it's an effective strategy for long-term investors who want to accumulate cryptocurrencies over time. 6. Trend following. Riding the market waves. Trend following is a strategy that involves identifying and trading in the direction of the prevailing market trend. The idea is to buy when the market is in an uptrend and sell when it's in a downtrend. Traders who use this strategy rely on technical analysis tools to identify trends early and ride them for as long as possible. Indicators such as moving averages, MA, and the average directional index, ADX, are often used to spot trends. Trend following requires patience and discipline, as traders must be able to stay in a trade as long as the trend is intact and avoid getting caught in market reversals. One of the challenges of this strategy is that trends can change suddenly, so traders need to be vigilant and use risk management tools like stop-loss orders to protect against losses. This strategy works well in markets that are experiencing clear uptrends or downtrends, but it can be challenging in sideways or choppy markets. Trend followers often use trailing stop-loss orders to lock in profits as a trend moves in their favor. 7. Arbitrage. Taking advantage of price differences across exchanges. Arbitrage is a strategy that takes advantage of price differences between different exchanges. Because cryptocurrency markets operate on multiple platforms, the price of the same cryptocurrency can vary slightly between exchanges. Traders using arbitrage buy the asset at a lower price on one exchange and sell it at a higher price on another, pocketing the difference as profit. Arbitrage opportunities are often short-lived and require quick execution, as price discrepancies between exchanges can close within minutes. This strategy is best suited for experienced traders who can identify opportunities quickly and execute trades efficiently. Additionally, transaction fees and withdrawal limits may impact the profitability of arbitrage trades. Arbitrage can be profitable but requires significant capital and the ability to manage multiple exchange accounts simultaneously. 8. Risk management. Protecting your capital. One of the most important aspects of successful cryptocurrency trading is effective risk management. Cryptocurrency markets are highly volatile, and it's essential to protect your capital from large losses. A good risk management strategy involves using stop-loss orders, diversifying your portfolio, and never risking more than a small percentage of your capital on a single trade. Stop-loss orders are designed to limit your losses by automatically selling an asset when its price falls below a certain threshold. Setting a stop-loss can help you protect your investments from sharp market downturns and prevent emotional decision-making. Diversification is also crucial in managing risk. By spreading your investments across multiple cryptocurrencies, you reduce the likelihood of a significant loss if one asset performs poorly. Additionally, avoiding the temptation to overtrade or use excessive leverage can help you maintain a more balanced and disciplined approach.